Hi there, and you're watching Dúchascopy TV. I'm Darren McDermott. Today I have John Coast Sullenger in the studio with me today from GAIA Capital to have a look at agriculture, gold and energy. Welcome, John.
Thank you.
So first of all, looking at the agricultural scene, what are we seeing?
Well, this year we've seen a big drop in some of the underlying commodities like corn. In fact, it's been a huge decline in the prices. And that's been driven by, let's say, greater plantings in the United States and especially, and also better weather around the world. Because remember that agricultural commodities are very driven by weather. On the other hand, what's quite interesting to note is that the equities actually have been more stable, let's say, in some segments. The biggest, let's say, losers on the equity side were the fertilizer companies, actually. Okay,
and where is the best segment to actually invest in?
Well, I mean, just to build on that theme, as I mentioned, what we've seen is this big sort of divergence between the underlying, which has really tanked in the last 6 months or so, 6 to 8 months, and the parts of the equity market which have remained quite solid. And where we're putting our bets and where we've actually been developing our business is in the, let's say, producing companies, the farming companies. These are companies that own and operate underlying agricultural land, so they have hard assets. They're producers of the primary resource, food. And those companies have been incredibly stable, and actually as proof, the GAIA Farming Index, which we launched back in February, the GAIA Farming 20 Index, which captures the 20 bellwether farm and producing companies, has actually been a big outperformer in this space. And so we continue to support that strategy.
So what's your outlook?
Well, the long-term outlook hasn't changed at all. I've said many times, I mean, we've reiterated that the demand outlook is extremely strong for the agricultural space. Most experts would say that by the year 2030, we have to produce 50% more food to meet the growing demand, and by the year 2050, as much as 80% more demand we're going to see in the market. So, given there are many constraints to the to production and to getting food to market, the outlook remains very positive. But year to year, we're going to continue to see a lot of volatility because it's very weather-driven in the short term.
And looking at gold, John, why is it so weak?
The main driver for gold over the past years has been the quantitative easing. And in the United States and other stimulus measures which have been put into place by governments around the world, mostly in the OECD countries. In Q1 of this year, I believe it was, the Fed came out and said, okay, QE is coming to an end. Investors got spooked and they bailed out of gold. And I think that that's what we're seeing right now is this weakness where investors still don't know, despite that we're still printing in the United States something like 80 billion of stimulus per month, which is quite at a record. We still don't know if this QE is going to last or not.
So John, can you just elaborate a little bit more on these drivers?
Well, look, the situation today is, despite the complacency, the situation is still pretty dire in the OECD world. I mean, economically speaking, all OECD countries, especially the United States, are at record debt levels. And the measures that are being put into place relative to the problem are still pretty minute. I mean, a friend of mine who's ex-colleague from Lombardier, Daniel Dunnard, quite very savvy investor, told me a funny story. He said, look, it's like a patient in a hospital who's terminally ill and he's taking, 50 pills a day, and they're reducing it to 48 pills. Well, does that mean, the problem's over? No, probably not. He's only taking 2 pills less. And it's very, very tenuous situation, even going from 50 to 48, if you can imagine that. And I think this situation applies to most of the OECD world. I mean, if you look at the south of Europe, the debt levels, and the United States, I mean, we're at unsustainable levels. So, gold, I think, is a play on that problem. And that problem is going to take many, many years to work itself out. And it's probably going to cost the currencies a lot.
And John, would you be more bullish on gold, physical gold, or gold equities?
Well, I think investors should have both in their portfolios, but I think today there's a particular opportunity in gold equities because the gold equities in the last 18 months have severely underperformed the gold physical price. And so if we do see an upturn, I think we could see a levered return through gold equities.
And John, looking ahead, how do you see gold trading? Higher?
I think gold is consolidating at these levels. I think that as investors start realizing that it's just impossible to end quantitative easing and other stimulus measures in the Western world, I think that investors will gravitate back to gold as a greater part of their asset allocation. So that means that I think longer term gold will continue to climb higher, and I see this as more of a correction in a longer bull market.
Okay, so moving on to energy, what are the fundamentals like today?
Well, I would say they're more healthy in terms of supply and demand and the spare capacity in the oil space, inventory levels and spare capacity, because several years ago we had a very, very tight supply and demand situation where there was only about 500,000 barrels a day of spare capacity. Today we have several million barrels a day. So fundamentally speaking, I think the oil price should be lower. But because we continue to have all this political instability, Syria, Iran, we've got the situation which is less publicized, but in Libya, for example, where it's really like a tribal leadership, and it's led to oil production actually going down. Because of those hotspots, and those are just a few of them. There's others like Nigeria as well, where there's let's say there's some pressure on production. I think that we'll continue to see this big premium in the oil price, and I don't expect the oil price to trade much below $90 a barrel. So I think the outlook is pretty stable. The other thing is that oil being produced today is much more expensive oil. It's even if it's coming from hydrofracking or let's say new technologies related to shale oil in the United States, the cost of this oil is much higher. So as you have a higher cost base, I think that's also going to help to support a higher price.
And speaking about hydrofracking that you just mentioned, how does it change the industry?
Well, the hydrofracking is kind of a generic term. It refers to all this fracking technologies which have been developed and elaborated on, and which are more than anything being employed in the United States on some of the let's say on some fields like the Balkan and the Eagles Ford and some others where the engineering companies have gone in and are greatly increasing production through using these new fracking technologies. So it's really been a game changer, and it's leading the United States to be in a position to be a major producer, actually, which was unthinkable 10 years ago. And it's changing lots of things, including it has a lot of geopolitical implications as well.
So looking ahead, what's your forecast?
My forecast would be that the oil price continues to trade in this range. I think that if we have a severe geopolitical shock in Iran or in Syria, I would even say that the impact on the oil price on the upside would be somewhat limited. By the same token, I don't expect oil prices really to trade down below $90, $95 a barrel. So I think we're supported on the downside. I think where there's opportunity is in the energy companies themselves, because investors, much what we're doing within GAIA, we're investing in companies which are beneficiaries from this new technology, which are engineering companies, which are companies which are developing new fracking technology, which is leading to greater production. And those companies are quite attractive on growth and on valuation, actually.
John, thanks very much for sharing your views today.
It's a pleasure.
And thank you for watching Dúchascalpaí TV. Do stay tuned as we have plenty more coming up on the show. See you soon.